and welcome to Energy Frontiers. I am Justina Okechukwu with this week's edition of the show, proudly supported by the African Energy Chamber. These are some of the biggest energy news we tracked for you in Africa and around the world. Africa-focused energy company Chariot Limited has announced the completion of a deal with Energen, a company that specializes in the exploration and production of hydrocarbon on the Moroccan offshore facilities. Chariot's chief executive, Adonis Porilos, provided a video clip update on the Moroccan deal.
We're really pleased to announce this morning that we've completed the deal with Energen, a deal we announced in December last year. What this means is that we have all necessary Moroccan approvals for the deal to proceed. That means that Energen is now the operator of both the Lixus and Rissana offshore blocks. And at the same time, pleased to announce that Chariot will be getting a $10 million cash injection as part of this deal. In addition to this, we've signed a rig contract with the Stena Group. It is the Stena 4th rig, and we should be drilling in the third quarter of this year. Very exciting. What is very important as well is that we have an option to drill a second well, which shows real commitment from the partnership to developing the Lixus and the Anchois gas field. As part of the drilling contract, we will be drilling the Anchois East well, and we'll be targeting not only the historical gas discoveries we've made, the A and the B sands, the C, the M, but we will also be drilling a pilot hole exploring the O sands to increase the resource base of natural gas. In summary, the drilling of this well with this Stena rig will lead us to a final investment decision, which means we're no longer an exploration company, we're a developer, which is something we've all dreamed of at Chariot.
And in Namibia, Hyphen Hydrogen Energy has unveiled the first of 10 new meteorological masts in the southern African country, which will be powered by about 7 gigawatts of on-site wind and solar power, with an annual capacity target of 2 million tons of green ammonia targeted mainly at exports. The $11 billion project was inaugurated earlier in the week by the Namibian President Nangolo Mbumba. Leaders from governments, private sector, and civil society organizations around the world will come together in Paris on May the 14th for the first ever Clean Cooking in Africa Summit. The African Development Bank President, Dr. Akinwumi Adesina, along with the leaders of Tanzania and Norway, as well as the Executive Director of the International Energy Agency, Fatih Birol, will co-chair the crucial event. African Risk Capacity, a specialized agency of the African Union, will host stakeholders in Africa's climate and food security landscape from May 7th to 8th in Johannesburg, South Africa, for a roundtable on matters of climate resilience and adaptation. At least 4 African countries, Zambia, Malawi, Zimbabwe, and South Africa, currently face adverse weather conditions that impact their agricultural crops. 3 of these 4 Southern African countries have declared a state of national emergency on food security. The Organization of the Petroleum Exporting Countries has predicted a strong growth in oil demand this year, with a global increase of 2.2 million barrels per day, driven by developing countries, particularly China and the Middle East. The group, in its closely watched oil market report from April 2024, says it expects the summer to see a surge in jet fuel use, with demand rising up to 0.8 million barrels per day compared to last year, while gasoline and diesel are expected to see modest increase, driven by economic activity. OPEC, however, warns that the robust oil demand outlook for the summer months needs to be carefully monitored to ensure a sound and sustainable market balance. And that's the summary of your energy news headlines. Coming next, oil prices are expected to hit $100 per barrel this quarter, according to a few market forecasts. Let's give you the perspective of an oil market analyst when Energy Frontiers return. Welcome back. Global oil prices are expected to maintain a bullish momentum in the second quarter, even as geopolitical tensions around Ukraine, Russia, and the Middle East continue to cause supply irritation, including a disparity in China's economic health and ahead of the US elections in November. Paul Hicken is the editor-in-chief at Petroleum Economist, a London-based publication focused on the oil and gas industry. In this interview chat with Paul, he tells me what the second quarter will look like for the oil market and the big risks that investors should watch out for.
Well, I think first of all is that you're going to see prices creep higher. On the fundamentals, look at the fundamentals, supply and demand. OPEC plus production cuts have taken that supply out of the market. US shale is not going gangbusters like it was previously, which often sort of offsets some of those OPEC plus cuts. And demand is holding up reasonably well, so especially across the US and China. So in a sense, it looks like prices will continue to creep higher for the foreseeable future. And yes, there is a risk premium in the market due to the sort of geopolitical tensions around Russia, Ukraine, and across the Middle East. But I think that risk premium is quite small still at the moment. It does create volatility in the market, and there is a kind of back and forth to sort of hang certain price moves upwards on geopolitical tensions across Russia and Ukraine and the Middle East. But I think we have to be careful to attribute the kind of tightness and actual overall trend to the market to what's going on there, because ultimately, you look across the Middle East, the actual tensions are not actually creating real supply disruptions. They're causing irritations to shipping flows and rises in freight rates. But actually, supply disruptions, they're not there. And it really depends what the market calculates in terms of an actual supply disruption. I think that's still relatively low, even where you see the tensions across that could spill over to, like you mentioned, Iran and the wider region of what we could see. But we've seen in the past, like with the attacks on the OPEC in Saudi Arabia in 2019, which was extremely significant and damaging for at least for a few days until things got back to a semblance of calm. But I think that's the tension, and I think that the market is still only attribute a small risk to a real widening of the escalation that could cause real physical disruption of flows.
Right. Now, you mentioned something. You said oil prices will continue to rise. Now, the U.S. Energy Information Administration has forecast about $90 per barrel average for Brent crude in the second quarter. Now, OPEC also released its prediction just today. Do you agree with this forecast by the U.S. Energy Information Administration?
I think certainly it's going to be in that range. I think it could well be a little bit higher even. I think I would say you could make a case for it being even more bullish than that. It could creep up to $95 a barrel even, depending on the fundamentals, because, again, there's still a little bit of uncertainty around US when interest rates are going to start coming down. When China is another factor, there's a lot of disparity about China's economic health and how much that will hold up and deliver the kind of oil demand that's going to push prices a lot higher. And so I think that's why there's been a sort of tentative move higher where OPEC has reduced supply, and there's and there has been a sort of moderate demand strength for oil. So I think that's why you see this kind of move upwards, but there's not real appetite to push it too much higher towards the $9,500 a barrel, because two reasons for the market ultimately, which is, first of all, that ultimately OPEC Plus will probably, unwind from their production cuts at some point. Most people think that it may well not be till towards Q3 even. But as you see, as prices keep creeping higher, there's more chance of the June meeting, when they meet at the start of June, that they start to unwind from some of these voluntary cuts. They're not part of the formal meeting, but they are still extra cuts that Saudi Arabia and other producers in that pact have taken on to try to take supply out the market. So we could see the first tier of those production cuts, which is those voluntary level cuts, being taken out first. And that could well happen as soon as June, depending on where prices are and how the market is and how fundamentals are going. So, but I think, first of all, that would provide a kind of psychological cap to the market, not to push it too high, because OPEC Plus could well and probably will unwind at some point. I mean, those extra cuts, those voluntary cuts, were a pain point for OPEC. We saw with Angola leaving over the production cut, the extra cuts. So I think it certainly was a pain point, and OPEC Plus will be keen to unwind, at least from the voluntary ones, as soon as possible, even with prices being this high, especially with prices being this high. And secondly, I think we're in a US election year, and I think there's also a risk that the US could release crude from its strategic petroleum reserve, its SPR. It's used as more of a market management tool in the past couple of years, and it could well do again to try and keep a lid on prices as well. So there's that element as well. So there's two. So there's those two sort of market management elements from OPEC and US, which keep a cap on prices. And then there's still an uncertainty about demand. I mean, you look at the disparity in the IEA and the OPEC demand outlooks, and it's exceptionally wide for this time of the year. And given that, and I think it partly people talk about the different ideological stances with the IEA and OPEC, but realistically, it's just the actual uncertainty over the economic outlook, really. I mean, for China and the US, the two big players, you'd say that it's very uncertain, and I think that's still the case.
When we return, South Africa is looking to drive the country's domestic demand for energy by using its gas resources. More on that in a moment.
We are done dreaming of an industrialized Africa. No more enduring long journeys in darkness. No more imagining life without constant power. We are done. We are done. Done tolerating 24 hours without power, load shedding, blackouts, and power cuts. Enough. Imagine a life where our abundant natural resources can't power a generation. We can't cope with that reality. 600 million Africans still lack access to power. We have the solution. It's time to turn imagination into action. African Energy Week 2024 is the platform to implement change, sign deals, and take decisive action. And implement. Join us. Invest in African energies. Energy growth through an enabling environment, and be part of the movement that brings hope to millions across the continent. It's not just about power, it's about empowering lives and giving African hope. Be there to witness the transformation. African Energy Week 2024, where imagination becomes reality. Secure your seat now. Don't miss out on African Energy Week 2024. Visit our website and buy your tickets today. Let's light up Africa and create a brighter future together.
At the time you need to build that project. Sign, baby, sign.
This is Energy Frontiers. Now, Africa's most advanced economy is looking to resolve the performance of the country's existing infrastructure and power plants in order to raise the energy availability factor to 70% by March 2025 from the current 58%. At the 2023 African Energy Week Summit, industry stakeholders spoke about how South Africa can employ innovative ideas to harness gas resources and create an enabling environment where both the private and public sector can boost economic growth and development. Here are excerpts from the panel discussion.
And I think the rest of Africa can learn from what Eskom has done. Even the rest of the world can actually learn from what Eskom has done. The EAF, the so-called EAF, energy availability factor, has now improved, and all the units that were affected a year ago, they are starting to come back the big units at our power station in South Africa, Kusile. They're coming back. 2 of them are back. The nuclear unit that is currently being upgraded to extend the life by another 20 years. It's coming back in the next month or so. So it's been great, given all the gloom that everyone was talking about, what was supposed to happen in South Africa. It has not happened. So it's great lessons learned that the rest of Africa can pick up from what Eskom has. So there's an opportunity there. I mean, the infrastructure, you just need to bring in the gas and perhaps look at how you can install gas turbines at those power plants. So there's an offtake of the gas already. But to take the gas from, whether it's from Mozambique or from Namibia or other parts of Africa and bring them to those power stations, you need innovative ideas, investors to put in their money, to build a pipeline to bring huge amounts of gas over a short period of time. It's not possible. Yeah. So you need to look at other innovative ways of how you bring gas to those coal-fired power stations that have been. But the private sector, as part of their contribution, they will have to also come with the capital to develop these projects, including resources and equipment, et cetera, et cetera. So that partnership is crucial. And also the minister spoke about the regulations. If there's gaps in the regulations, we need to very quickly close those gaps going forward.
I think with gas, South Africa has actually quite a mature gas market. We've been importing gas for the past 20 years, but it's not being used for electricity. It's being used for the petrochemicals industry, predominantly, and industrial heating. That gas is going to be declining, and the point that we want to make is where we're in an electricity crisis today, we're actually going to be in a gas crisis in 3 or 4 years' time, right? And so, though the opportunity to utilize gas and electricity is critical, it's also within the broader energy sector that we need to think about gas. But while we exist in that environment, we also have a very unique position in that regionally there's an abundance of natural gas, Mozambique, Namibia, and so the opportunity for regional integration is really there to import the natural gas. It's also with that there is the fact that the reality that South Africa itself has got significant potential for natural gas, both onshore, Kinetico, they've made some recent onshore discoveries, offshore with Leopard and Broopada, but also in relation to what's potentially there in the Orange Basin, which the minister alluded to, which is really a game changer if we really get to extract it. So the opportunity for gas is massive, but I think the immediate response is, well, we do need gas right now to enhance the energy availability factor, to convert our diesel peakers to actually natural gas. And there is a business case to do that right now, which is an LNG discussion. And I think there's a role and there's a place for all three opportunities. So if I may come in there, I think just to go back also to your first question, I think one of the most interesting things that I've seen over the past 12 months is the fact that there is, to Jacob's point, the convergence with the private and the public sector. I think there's a lot more willingness for there to be that collaboration. I think that's coming out very strongly. And I think that really is an answer to the problem at hand. I don't think South Africa's problem from a gas perspective is going to be a lack of financing. I think the money will be there. I think we need to get those sorts of projects to the point where they can be financed. And I think that's where we found a lack of. And I think if we can speed that up, the money issue will be taken care of, because the economics of it, the techno-economics of it, make absolute sense.
We're looking at gas as BPA, and we say it is a transition fuel. And definitely it is a quick vehicle that can plug the holes. But we need to ensure that, while we're looking at it from South Africa point of view, and we're living in the community called Africa, and in there is definitely abundance of gas. Neighboring country, Mozambique, Namibia, they've just made some massive discovery of gas. And that therefore, there's an opportunity in terms of the inter-Africa trade to see how do we then, exploit that relationship that exists amongst us. And therefore, we could really look at the gas as a winning card on the short term, and possibly so in the medium term, medium term as well. But I do think that when you talk about the infrastructure that will enable the supply and the delivery of the gas, this is where I think as a community, college, the business, government together, we need to come together and say, how do we debottleneck those areas?
Yeah. I mean, if you look at some of the options that have been looked at now by various parties, is that you have a lot of users or end users of the product that are interested in seeing long-term sustainability and ensuring that the product continues to flow. And tapping into their combined balance sheet is one way that we could actually develop the gas projects in the country. And this is nothing new. If you look at on the other side, on the logistics side, if you look at the coal terminal in Richards Bay, I mean, how that was put together. I mean, it's obviously the end users that saw the need, I mean, for the terminal to be there. So you could actually, using a combined balance sheet of these entities, get these projects going without necessarily heavily relying on private financial parties.
The Association of Service Providers of the Angolan oil and gas industry has partnered with the African Energy Chamber to promote investment opportunities in Angola, as well as partnerships with Angolan services companies. The association will lead a delegation of Angolan companies to this year's edition of the African Energy Week conference, scheduled for November 4 to 8 in Cape Town, South Africa. Join the African Energy Week and be a part of the conversations, and go now to the event website and register at www.aecweek.com. And finally, in this edition of Energy Frontiers, a leading woodwork manufacturer in Kenya has integrated the use of solar power to cut down electricity costs by about 40%, boost competitiveness, reduce carbon footprints, and pave the way for a greener industry. The project was financed by the Equity Bank of Kenya as part of the bank's capital investment program for manufacturers. Let's watch this video clip of the amazing innovative energy investment being promoted in Kenya, courtesy of the Equity Bank.
My name is Elliot Gadesha. I'm the director of Elifani Furniture Limited. Has been in existence for nearly 34 years. Our core business is manufacturing woodwork, and that's all we do. We decided to go solar because of the cost of electricity, so that we can remain competitive.
We are a solar EPC company. We deal with solar installations from the process of development, procurement, and actual installation up to operation and maintenance of solar systems. So we install solar for various clients, institutions, residentials, and even commercial, which is the large industries. We are installing a 50 kilowatt solar system. 50 kilowatt is having 93 panels. Each panel is producing 550 watts to run the factory. The system is grid-tie system, meaning that it does not have any storage. You're consuming solar as it comes. So it makes the system very feasible and also very simple to install and use.
We expect to cut down expenses on electricity by 30-40%, depending on how efficient we get. Solar, because of going green, we need to conserve the environment. The sun will come anyway and it will go. So it's being wasted. And diesel is also not clean energy.
We have a diesel generator that we have been using as an alternative when we're having blackout during the day. The cost of running the diesel generator is the same as the cost of electricity.
It's quite timely that we can do 24 hours. During the day, we are supported by solar, and then during the night, then we use the KPLC power. Equity are a lot easier to deal with in terms of conditionalities, and they were offering solar as a part of their capital investment on manufacturers. We banked with them for a long time. We found their conditions very dear. We are happy to partner with Equity on this.
One of the biggest barriers to solar is usually the initial capital. We partnered with Equity and we were able to come up with a financing model where Equity can be able to fund for the project and you pay in smaller installments. So that means that you get to enjoy the facility without having to output high investment in the system. Given the savings of the system, this money comes back to you, so you have a very good ROI.
The capacity is about 51 megawatts. Our capacity at the moment is about 150.
We are expecting from 20 to 30% savings on their consumption, annual consumption, and also now transfer the same to the customers. Of the many tenets of renewable energy, solar is usually the most feasible and the simplest to use. Solar works for all clients. This one is large because it's for an industrial customer, but now for your own use, you need a smaller system. And also for residential, you also need batteries, because you find that for residential, you use at night mostly.
And that's the package of Energy Frontiers for you at this time. We appreciate your making the time to watch the show. Remember to follow the program on Frontier Africa Reports website, like all of the video editions, send in your comments, and subscribe to our YouTube. Follow us as well across all our social media handles as indicated on the screen. I am Justina Okechukwu. Bye for now.